I'm here to introduce the Family Bank Rights Offering. Investors are charged with the responsibility of delivering returns to their stakeholders. The pursuit of these returns are guided by the investment objectives of the portfolios being managed. Higher returns need to be delivered against the risk of inflation and the loss of capital. The risk of inflation is a function of tenure. The longer the money is put aside for investment, the more capital can be utilized in comparatively riskier but higher performing assets. So although these continue to provide various opportunities to investors as well as meet liquidity needs, their shortcomings have seen the rising prominence of other alternative asset classes, such as property and unquoted equity. The interest in property has seen the introduction of regulations by the Capital Markets Authority in the development of real estate investment trusts that were enacted in June 2013 into law. In this case, with the amount of successful developers we have in town, I think we can say that the fund managers was slightly behind the curve, joining an investment opportunity that could offer affordable diversification to their portfolios. For unquoted equity, we are hoping to perform better and be more bullish towards investing in private companies that contribute immensely to the growth of the economy. The growing demographics, which is considered young, educated, and able, supported by a vibrant informal sector, underpinned by a stable political environment, is what is driving this growth. The percentage of people between 14 and 54 years as of 2014 is estimated to be at least 51% of the total population in Kenya. This growth is considered to be tangible, fulfilling a fast-changing market need as more people seek to better themselves. As investors, we have a fiduciary duty to capitalize on these opportunities locally in search of higher returns while monitoring our risk and liquidity appetite. We can contribute to economic growth by utilizing the long-term savings which we are entrusted to manage and invest them in promising private companies from sectors we believe that will assist us to meet this objective. Small and medium-sized companies were estimated to contribute over 25% to the GDP as at 2012. This has always been the case in more developed markets and is a model we believe will catapult our local and regional economy further. The banking sector is the lifeblood of many economies, and Kenya is no exception. It interfaces with several sectors of the economy and continues to contribute, with total sector assets growing by 16% to 2.7 trillion in 2013. In addition, this sector is highly regulating, surpassing some global banking standards, and is also highly competitive. Therefore, to be good, you need to be excellent. The banking sector also has an overarching responsibility of financial inclusion, which has improved from 24.7% in 2006 to 66.7% in 2013, and availing credit to growing businesses, most of which could be considered informal. Family Bank, the reason why we're here today, started out in 1984 with the aim to be the institution of choice for the unbanked population. The aim then and now continues to serve the needs of the overall market. Some of the milestones that Family Bank has met are: in 1985, it opened its first branch in Kiambu. In 2003, it had a smart card and paperless banking launch. In 2006, it had its sale of shares to customers and staff. In 2007, it converged into a fully fledged bank. In 2009, it had the rights issue and private placement. In 2010, it had investment by strategic investors. And in 2013, the bank hit a 1 billion profit before tax. So therefore, this is a bank that is transforming and requires the support of investors. As an investor, the need to provide patient capital and have a longer-term view on this investment opportunity is desired. The historical growth that it has enjoyed and will continue to enjoy should be your motivating factor. Without much further ado, I would like to formally welcome you all to this investor briefing